Welcome, everybody. It's Greg Schnell, and I am here with Martin Pring to do the market roundup for November the 3rd, 2019. We have had a big banner run in the markets over the last couple of weeks, lots of things breaking out to new highs, and Martin's charts have been pointing us skyward for a month now. I think last month he was pretty bullish. But anyway, I've got Martin on the line with me, and we're going to roll through some charts together today. Martin, how are you?
I'm terrific, thanks, Greg. I understand you're a refugee from Canada this week.
I am. I'm actually hiding in Scottsdale this week. There was snowfall in Calgary for today, so Scottsdale looks pretty good, actually. All of a sudden to get away from the white powder, so it's nice.
You must have known that the Canadian dollar charts are looking pretty good, so you can get more for your buck down here now.
Yeah, I got to tell you, it sure would be nice to get more for our buck because it's been depressed for a while. So, yeah, what have you got to show us today?
Okay, well, let's just quickly go through a summary here of what the main points we're going to be covering. First of all, there's tentative signs that the slowdown is ending, and that's, of course, one of the reasons I think why the stock market's breaking out to the upside is because it senses that some of these really long leading indicators have now started to turn up. Number two, stocks aren't just breaking out in the US, but they're breaking out on a worldwide basis. The Dow Jones World Index has broken up, so has the broken out, and so has the MSCI World Stock ETF, the ACWI, and it seems to be being supported by a lot of other countries, individual countries, such as, well, like the Eurozone, which isn't an individual country, but it's a big trading block. So a lot of these things, Japan has broken out, and I'm talking on the ETF basis here. So I would say just about everything is broken out, but there's a substantial number of individual ETF country markets that have broken to the upside. I think bond yields are likely to extend the range-bound action we've seen for the last, 2 or 3 months, and that will be a range-bound action as a prelude to bond yields moving significantly higher. And when we look at commodities, I think this is the main thing we're going to be talking about today. Is commodities are still in a confirmed bear market because the CRB composite and the CRB spot raw industrials are both below their long-term moving averages, and then their long-term momentum, their KSTs are still negative. But there's a lot of interesting other evidence that suggests that might be about to turn. And usually in a business cycle, what you have is that bonds bottom first, which obviously they have, then stocks bottom, and then the next thing to look for as the recovery starts to get underway is for commodities to bottom, and that's the thing I'm looking ahead for now. Obviously the stock market bottomed some time ago, last December, and is out of the barn now. That horse is out of the barn. But the next thing to look for is commodities. And I see a lot of favorable signs for commodities, but we're not quite there yet in terms of saying the odds strongly favor a bull market because we just don't have those long-term technical signals. But I wouldn't be surprised to see some of them being given in the year-end period in November, December. So let's just take a look at the world scene here. This is the MSCI World Stock Index, the ACW, or World ETF, I should say, the ACWI. And underneath the two economic indicators, one is actually they're the same indicator and treated in a different way. The one in the bottom panel is the OECD leading indicator, and it's amplitude adjusted. That's the raw data, and you can see that's still declining. So what I like to do sometimes is to try and come up with a derivative that leads the indicator that it's following, and that's what the indicator in the middle panel is. It's a derivative of the indicator in the bottom, and the vertical lines you see here are periods when the derivative bottoms out. And as you can see, when the derivative bottoms out, it can be a leading indicator for the actual indicator itself, and sometimes they turn simultaneously. Main point to bear in mind here is that it's now been turning up for a couple of months here, and this data only goes back through, I think it's either August or September, so it doesn't include the latest data. So it looks to me like it started to turn up, and if you look to the right of these vertical lines, you can see what happens to the stock market is it tends to experience a bull move of some kind. The one exception was in this period here when we got a buy signal, 2010 2001, and it didn't translate. The improving economy didn't translate to higher stock prices. And during that period, of course, the ACWI was below its dashed red line, which is the 12-month moving average, which is in total contrast to where we are today, where it's above the average. There's some other indicators that suggest to me that the market's going to move high. We'll get to those a little later. I just want to focus on the economic situation right now, because when the economy improves, typically it has a very strong correlation with stocks moving up as well. So this chart here shows a leading indicator of the economy, the chemical activity barometer, which we've looked at on several occasions in the past. And the reason I like it is it goes all the way back to when the Federal Reserve was founded in 1912. So we've got a good history on it. And it also has got some unique stuff because they use movements in the chemical supply chain, leading indicators of the chemical supply chain, to also incorporate into this indicator. The red highlights represent recessions, and the beige highlights represent slowdowns. And if you look at the situation since 2007, we had the recession in 2008, 2009. And since then, we've actually had a couple of slowdowns, which we got out of in 2011, 2012, and 2016. And in the last 18 months, we've been another slowdown. So this indicator, what the market, I think, is saying is that we're going to emerge from this slowdown, and this momentum indicator of the chemical barometer is going to start to turn up. And it better do so pretty soon, because the chemical barometer last month in October crossed below its 18-month moving average. And almost every situation in the past where it's crossed below its 18-month moving average, we've seen a recession. But there have been some exceptions, like in this period here, where you can see it just nicked below it very slightly, as it has now. So I think we've reached a very important point as far as this particular piece of long-term economic evidence is concerned. So we want to see this thing start to turn up. There's a couple of reasons why I think it's going to do that. First of all, one of the most long leading indicator there is housing starts. And we got the KST for housing starts in the bottom window. And it's just started to turn up. And that is a very, very important signal, because it has led every recession since the 1950s by turning up, and it's had varying lead times, but it has been pretty consistent. So that's a positive sign. But you can see that it's just about turned up. It hasn't given us a strong signal yet. That's where all these other indicators come in, because when we look at the business cycle, we look at it as a chronological series of events that keep repeating. And this is a kind of a chronological sequence of events for the housing market, where we look at the momentum of new homes for sale in terms of inventory. We look at corporate bond price momentum. We look at new home sales momentum, because we're not going to get housing starts unless we get sales. So this is a kind of a rough chronological sequence. And if I put that arrow in, you can see that it translates a little bit to the right. It doesn't look like much, but remember, 1970, for example, was only about a small amount of space in this chart. So it is a definite lead time. I can put the others in too, all the other lows in the inventory sales ratio, and you can see that generally speaking, sometimes not much of a lead time, as I wasn't down here in 1995. But in most situations, there's a lead time between when this indicator starts to turn up and when housing turns up. So I mentioned that housing had just anemically turned up. But more important, it's turning up as part of this sequence, because the inventory sales ratio has turned up, corporate bond momentum has turned up, and so is new home sales. So to me, that suggests that the housing market is in a chronological sequence to suggest that housing starts are going to move higher. If housing starts to move higher, it's not a big part of the economy, but there are some secondary effects, like if you have new houses, they have to be furnished and so forth. So that's a very positive indicator. And then the other one is Pring leading economic indicator. This one here we can take back to the 1950s, and one of the ways in which we try and identify when we're going to have a recession is when the momentum indicator down here, which I call the recession caller, starts to move below this red recession line here. And you can see every time we get a recession, this indicator crosses below that red line, or it's either just crossed or it's just about to cross. And so what we're seeing right now is that the indicator is actually moving away from that recession line, which gives me encouragement that we're on the right track in terms of getting out of this slowdown that took place. So now we're back to the world index again, and this is, I put a cop-up curve up here for the world index, and the bottoms in this cop-up curve, when it bottoms out from below zero, have been flagged with these green arrows, and pretty well every situation except 2001, we see a rising market following the cop-up curve bottoming. And as you can see here, it definitely is bottom because it's above its moving average right now. So that's a pretty positive sign going into this breakout period, which we'll look at a little bit later on the MSCI ACWI. But here's now we're looking at the US, and we're looking at another interesting indicator. This is the financial velocity indicator. And this one, what we do is we add up the 18-month rate of change for the three markets, bonds, stocks, and commodities. And when it starts to turn up, that indicates that there's enough liquidity going into the system that it's typically consistent with rising stock prices. And if you look at to the right of these vertical lines, you see in pretty well every situation, the stock market, US stock market rallies after this indicator bottoms out. Well, fast forward to the present, you can see once again, it's just last month crossed above its moving average. It bottomed out several months ago, but it's now just crossed above its moving average, kind of acts as a confirmation. So that's pretty bullish, but it's obviously not very overextended at this point here. Another thing I like to do is to look at commodity prices as a way of forecasting stock prices. And in the top window, we've got the US stock market, the S&P, and underneath is an 18-month rate of change of the CRB Spot Raw Industrials Index. And the vertical lines show you the lows in the 18-month rate of change of the CRB Spot. And you can see what happens to the stock market. Well, first of all, let me back up and point out that the red highlights represent recessions and the beige highlights represent slowdowns. So when the commodities bottom out, it's a pretty good indication that the economy is also bottoming out as well. And so if you look at these green vertical lines, which flag the lows in this indicator, and you look and see what's happening to the stock market, it follows with a rally. It follows with a rally because the economy is emerging from a recession like it did here and like it did here. And over here in 1963, it was emerging from a slowdown. Right now, of course, we don't have a recession, but we do have a slowdown that we pointed out before. So when this indicator starts to bottom out, it should indicate or should confirm that the slowdown has ended. And not only that, but that will be another favorable factor for the for stocks. The only time this model didn't work was in 2001, where it correctly predicted or it correctly identified the fact we were coming out of a recession. But in that period, the stock market chose to ignore that good economic news in favor of the fact that they were unwinding the tech bubble at the time. So there was kind of special factors going on. But consistently throughout this thing, you can see as the momentum bottoms in commodities, so the economy either comes out of recession or emerges from a slowdown. So right now, that indicator is still bearish. It's just ticked up slightly, but you can see it's pretty oversold, not as oversold as it has been on some occasions, but it's certainly primed, ready for a reversal if you could have some other indicators which will back the idea that commodity prices have bottomed out. And we have those indicators, or some of them. So this one here shows the inflation-adjusted S&P composite. And underneath is the Shiller price-earnings ratio. And then we have a momentum for the Shiller, which is the KST. And these arrows show you when the KST for the Shiller bottoms out. So when you look up here, you can see that with one exception, I think it's this one here, the bottoming out the Shiller PE has been followed by higher stock prices all the way through. I can't find any other exceptions here. And that's good news because right now the Schiller price earnings ratio has just crossed above its, or is just about to cross above its moving average, giving us a buy signal. Looks like the KST has bottomed. Just need a little bit more evidence here to kind of push it up through. But certainly the trend of the PE is an upward one because it's above its 48-month moving average. That's this dashed line, and it's above this trend line here. So that's pretty positive. What's not positive on this chart is the fact that at this point here, when it reached its cyclical high, the Schiller price earnings ratio was at its highest level ever, except for during this period here, the late 1990s and the early part of the 2000s. When you have a very high price earnings ratio on the Schiller basis, that tells you that the market is much more vulnerable than normal. But getting to that point, you've got a positive trend in the indicator. And as long as the trend is positive, in my view, trend trumps everything. So what we're seeing here is a bullish reading here, or a close to bullish reading on the KST, suggesting that Schiller is going higher. That's bullish for the market. And that's going to create a nice party. But once that party is over, then you're going to be in a situation where the market could be extremely vulnerable. But I think that period would be at least 6 months to a year or 18 months down the road. So I'm not worried about that right now, but I will get worried if this, say the KST starts to turn down and we get some other long-term indicators start to turn down. But right now, everything's looking, well, not everything, but most things are pointing north here in a very encouraging fashion. Here's another indicator that's just on the verge of giving us a buy signal. This is the KST for the inverted dividend yield. When it bottoms out, that's when we get one of these vertical lines here. And each time we get a vertical line, what happens to stock prices? They go up. So that's pretty consistent too. And it's one of my most consistent long-term indicators. And right now that indicator is right at its moving average. It's within a whisker of the moving average. So if we get just a little bit of an up move in November, this thing is going to go positive again. So that looks pretty good. So I just want to just tie in the relationship between the economy and commodity prices again. So the vertical lines show you when the OECD leading indicator, which is treated as a normalized indicator in this case, when it bottoms, what happens to commodity prices is they invariably go up. There are a couple of exceptions, such as this one here in 1998, 1999. But most of the times when this indicator bottoms out, we get a rising period of commodity prices. And if you remember, the leading indicator we saw in the first chart has already started to turn up. This one hasn't yet turned up, but it's very overstretched on the downside. And it tells us that the global economy has already gone through not a recession, but certainly a serious slowdown. And based on historical norms, when it reaches this green line, chances are it's going to turn up. And if that was the case, then commodities would start to turn up as well. So here's one other commodity indicator. This is CRB spot raw industrials. Vertical lines represent the periods when the 12 plus the 18-month rate of change bottoms out. And pretty well in every situation, commodities are in the process of bottoming out when that happens. A couple of exceptions where it bottomed out for a very temporary period. I say temporary, but you know, its chart goes back to 1959, so that space there represents about 6 months. So that could be a lifetime in today's markets, of course. So anyway, the couple of things to watch is the fact that all three of these rates of change or combination of rates of change are in a downtrend. Some of them are just, this one has just edged through its downtrend line, but the other two are still below. And the rate and the index itself is already below is still below its line. And it's worthwhile waiting for a breakout, because what happened the last time we had a breakout, when all three broke out and the price broke out, the CRB spot raw industrials experienced a nice rally. The actual indicator for the price here was not terribly tiny because it occurred a little bit more than halfway up the bull market. But it looks to me like although we can't say it's bullish yet, it looks to me like it's prime ready to go. It would only take a little bit of strength in this indicator to move up, and that would probably be kind of like a reverse domino, tipping everything else up as well. So when we look at the our global index, and we measure that in terms, not in terms of the CRB spot raw industrials, which is just concentrated in industrial materials, but if we create a global index out of the CRB composite, which also includes agricultural products and is much more broadly based, we can see that it's on the verge of a buy signal. It's still negative because it's in this trading range, this triangle. It's trading between these two converging trend lines here. But it wouldn't take much for the CRB composite on a global basis to start to turn up, and that would be highly significant. What you can see is that what we have here is really three lows in the CRB, the global CRB, all at the same level. Yet when you look at the KST, it is actually right at rising levels. So you've got a positive divergence here with the KSTs, KST bottoms, and it wouldn't take, and that would be confirmed if the global index just experiences a small rally and takes it through that downtrend line. When we get into the StockCharts platform, you'll see that on a weekly basis, this indicator is very close. Not this particular indicator, but the CRB composite itself in dollar terms, it's very, very close to an upside breakout. And the momentum is also positive. We'll get to that a little bit later. So now I just wrap up this part of the presentation by just going through the schematic diagram that I've done for the last, 6 months or so. What we're looking at here is the long-term KST. This is a kind of a theoretical long-term KST. And we split up the KST into 4 parts or quadrants. When it's declining and it's above 0, we see that's in the fall, on the autumn. When it's below 0 and falling, we say that's in the winter. And when it's in the spring position, it's still below 0, but it's in a rising mode. And then the summer mode is the markup mode when it's above 0 and rising. So what we like to see is where the various industry groups and sectors are in terms of their position as regarding the seasonal momentum. When we see, as we saw in 2007, a concentration of S&P groups and industry groups in this position here in the full position, that's what a market top looks like. And a market bottom looks more like when there's a concentration here of sectors in the winter position and in the spring position. So let's go and take a look at where we are today. So here's the theoretical long-term position of the KST for these individual indicators. So that's where bonds are right now. They've gone through their turnaround phase, and they've been in an up phase for quite some time. So they're getting into I would say, overextended position, but they're well up on the curve. The S&P has moved to this point here where it's in the summer position. And industrial commodity prices, the CRB spot raw industrials, are still in this position here. As we saw in some of those indicators, the long-term momentum is down and slightly overextended on the downside. So in this cycle, we've already seen bonds turn, we've already seen stocks turn. The next thing we need to look for is industrial commodity prices to turn. So what we're going to do now is going to put up all the early cycle leaders in terms of sectors. Those that do well coming out of a recession or coming out of a slowdown, interest-sensitive things such as consumer utilities and staples and REITs and things of that nature, defensive plays. And then we're going to put out the late cycle leaders, the ones that are earnings, so-called earnings driven, things like materials, resource-based stocks, and so forth. So let's just put up and see where all the early cycle leaders are. And you can see the utilities and the REITs and the telecom, home builders, staples, all these are early cycle stocks. The majority of them are over here in the summer position. And then when we look at the lagging sectors, we see that the same thing is going on, that the majority of them are on the right-hand part of the diagram in the markup phase. So if we were coming out of a recession, what we would normally expect to see is everybody in this section over here, either in the winter or the spring section. But we're coming out of or I think we're coming out of a slowdown. And what we're seeing here is a lot of what happens in a slowdown is that instead of going into a recession, the economy bounces off zero and moves up. So what's happened in this case is a lot of these groups, like the S&P itself, have moved from being in the fall position and they've gone straight over into the summer position. There's nothing wrong with that. The only thing is, of course, it's much better for everybody to be down here, because that means you've got several years of potential growth on the upside, whereas you're already into this growth period in terms of this momentum. To give you an idea of where we are now in terms of sectors relative to where we were in 2007, here's the 2007. You can see everything's, this is December 2007. Everything's concentrated either in the fall position or in the late summer, where they're up here and very overextended and starting to turn down. So our current position is very dissimilar from where we were at a market top. So that's why, one of the reasons why, because all these groups are right now, they're over here in the summer position. One of the reasons why I think this is a valid breakout on the upside. But that will move over now to the StockCharts platform. So here we have the MSCI World Stock Index, and I just wanted to show you this beautiful consolidation that's been taking place for since January 2018, and a little bit of resistance over here. But there's no doubt that this world index has broken to the upside. And as I say, the Dow Jones World Stock Index is also, or Global Stock Index has already broken out in a similar way. And it's being supported by advanced decline line. This is my global advanced decline line, which you can plot by putting in the symbols exclamation mark, PR, GLAD. That gets you the global advanced decline line. And it was started to actually lead the market higher back here in the summer, and is still in a strong uptrend. So that, to me, that's a good solid confirmation of the world index breaking out to the upside. Let me just get into the view all mode here, and scroll on down here. So here's the NYA, a New York Composite, which has a similar pattern to the world index, and it too, as you can see here, is broken out to the upside. Whereas the S&P has been kind of, it had its sell-off during this period here in 2018, and then since then it's been zigzagging higher. So the NYA, the New York Stock Exchange Composite, has been tracking more or less with the world stock index. You can see it's comfortably above its 12-month moving average. And earlier on this year, the Kopok indicator for the Kopok curve for the NYA started to turn up. And now we're seeing that this indicator here, the long-term KST, is also just about to cross. I'm not sure if it's crossed its moving average, or it's just about to cross. It's a pretty tight fit anyway. It looks like it's going higher too. So we're seeing both indicators starting to turn up. Because sometimes when you get a Kopok indicator turn up, because it's more sensitive, you don't necessarily get the follow through on the KST. But here we're definitely getting some follow through on the KST. So that looks positive and validates the breakout on the New York Stock Exchange Composite. This indicator here is kind of interesting because in the bottom panel, it calculates the KST for the ratio between the XLF, the financial ETF, and the S&P. So it calculates a relative strength line, and then it takes that relative strength line of the financials and turns it into a long-term KST of that, or the momentum of that relative strength. The point being that when you have positive relative strength or momentum for the financials, that tends to be bullish for this indicator here, which is of course the S&P composite. So that's what we're doing here, and we're looking at the lows in the S&P, the KST, the long-term KST, to the highs, and then shading that in green, and you can see in each of these situations the market does much better. And that indicator has been bearish for a while. It hasn't stopped the market from going up, but it looks like it's just about to turn to the upside, especially as the financials have just made a new high as well. So that suggests that what this model is going, or this approach or technique is suddenly going to kick in on the bullish side for the stock market. So here's another important ratio. This is one I've shown you several times, I think, in the past. This is where we divide the XLK technology by the XLP, the consumer staples. So we got speculative technology against defensive staples. So when this is moving up, it means that investors or traders and investors are moving into the technology relative to the staples. It doesn't say staples are going down. It just says that the technology is doing better than staples. And the green highlights represent, using the benefit of hindsight, where you get a low in the ratio and a high in the ratio over an extended period. And that's when we get one of these green shaded areas. And I said it's done with the benefit of hindsight. But it does demonstrate that when the ratio is rising, favoring technology, so the S&P tends to rise as well. And if the ratio is falling, that's when the market's going to be at its most vulnerable. It doesn't say the market's going to go down, because it didn't go down just here. But it tells you that it's at its most vulnerable when it is going down. So right now, we've been in a green shaded area since the beginning of the year. And I think that green shaded area is likely to extend, because what we're seeing is a breakout of this consolidation, reverse head and shoulders on the upside. And that suggests to me this is going higher for the next few months at least. And if that's the case, that's going to be a positive backdrop for the S&P. So we've got all the right things going for us here. So one thing has not quite turned bullish yet, and that's the ratio between stocks and bonds, the SPX against the TLT, excluding dividends and excluding interest. So this is the pure price basis. And you can see that the ratio has been bouncing recently, and it's just below this important downtrend line, this green downtrend line. It's also just below this 200-day moving average and this extended breakdown trend line if you take it up there. So it's at a very, very crucial level here in terms of resistance. And when you look at the special K in the bottom window or the middle window here, you can see it's been in a downtrend too. It's below its moving average, and it's below this trend line here. So this is something I'm watching, because when it breaks to the upside, that would suggest that stocks are going to beat bonds. Now, they've obviously been beating bonds since in the last few months, but we want to see a trend break here to kind of give us another favorable indicator for the stock market. One interesting change that I've observed is this ratio here. This is the ratio between gold and the Dow Jones Internet Commerce Index. The Internet Commerce Index has been one of the strongest indexes in the last 10 years. I don't know how much it's gone up. I think it's 10 or more fold. It's been a remarkable run. So what we're seeing now is that the ratio between gold and the Commerce Index looks like it's reversing. It's broken this steep downtrend here. But by moving above this previous high here, it's now got a series of rising peaks and troughs. And the 12-month moving average is also, its position of that is also positive. And so is the long-term KST. So it looks to me like gold is going to outperform on a trend basis the Dow Jones e-commerce index, which kind of an interesting observation. Now we move on to bonds. And what we're seeing in the bonds is we've got a 12-month rate of change of the 10-year yield in the bottom window. And every time this ratio gets down to the green line and starts to reverse, or gets below the green line and starts to reverse, we get one of these green arrows. And if you follow these green arrows all the way through, they've been followed by a nice rally in yields. Not nice, I guess, if you're long bonds, but it certainly has been a significant rally in yields. So what we're seeing is the 20-year yield, the 10-year yield, I should say, is come down to this level here, just a little bit below 1.5, and each time it's sort of bounced, and it looks like it's starting to bounce now. And the actual reading is not as strongly up as that makes you believe, because this is a monthly chart and we're only in about the third trading day of the month or whatever, second trading day. So that last plot is kind of invalid because we've got so much more of the month to go. But it had started to turn up And there are some other indications that suggest that bond yields are going to rally here. One of that is this chart here. This is the 30-year yield up here. And you can see that whereas the 10-year yield was at a horizontal level where those lows were, the 30-year is one where the lows have been progressively lower and lower and lower. So you can draw a nice little support trend line. You can see the yield bounced off that support line, came back to test it again, and then bounced again. And the intermediate KST has just gone bullish. And in the past, when you've reached the kind of level where it is, around where it is now, when it's overstretched level and reversed, that's when we get one of these green arrows. And in each of those situations, we saw that the yield responded with a rally. Now, remember also in the previous chart, we had the 12-month rate of change starting to turn around as well. So this kind of reinforces the idea that bonds have reached their low and are now likely to experience some kind of a rally or some kind of a ranging action. And that may be a prelude to the bond market reversing its secular downtrend line. Some of the early maturities, like the 5-year, have already reversed their secular downtrend line, but the secular downtrend, that hasn't quite translated to the 20 and 30-year maturities yet. So here is what I think is probably a really important relationship. This is the commodity bond ratio. It's kind of the ultimate inflation-deflation relationship we get in the financial markets. And you can see that the ratio is right. This is a 1 year, just over a 1 year downtrend line. And it's, so I should point out, when it's falling, it's deflationary because bonds are outperforming. When it's rising, it's inflationary because commodities are outperforming bonds. So right now we have a downtrend in terms of favoring deflation, but it looks like we may be we're very, very close to a possible reversal, and a possible reversal in this downward movement in the special K as well. And special K has done pretty well in the last couple of times. Here we got a special K downtrend line reversed, and we got a rise in the ratio. And here, this line's not quite drawn correctly. It should be touching that low and this low here. So that's a bit of a naughty trend line there. It should be touching these points, not away from them. So I apologize for that. But the point is, when the trend line was broken, where it would have been drawn properly, it would have been broken more or less in the same spot. And also where that moving average was crossed, and that would have indicated a downward movement in the ratio, in other words, favoring deflation. So right now we're poised to break to the upside. You can see the KST is in a bullish mode and it's not yet overextended. So in the next couple of weeks, we watch this, it could break to the upside. If it does, that would strongly favor commodities over bonds. And that, of course, fits in with the idea of coming out of a slowdown. So here's the CRB composite. And underneath is its cop-out curve. The solid arrows show you that you've had, when the curve is reversed, you've had a solid rally or a consolidation that's taken place. The dashed lines basically indicate failed signals where the cop-out turned up and the indicator, the CRB continued on this downward draft. One of the points to bear in mind here is that when we get one of these false signals, generally speaking, the index doesn't break above its moving average. And that was true of this false signal here. It wasn't true of that one, but look in the current situation, it's just edged up through its moving average. But just remember, this is not the end of the month yet, so that's not really a true plot. That's what you might call, in quotes, an estimate. There's a lot of the month of November to go by yet before we get the actual data point for this month. But it sort of shows you that it's not, if the month closed where it closed on Friday, you would definitely have a buy signal here above its moving average. Not a strong buy signal because it's only an anemic break, but certainly something you could put into the bullish count, a piece of evidence you could put into the bullish count. Now we're going to our second panel. And here we see the CRB composite in the top window. And once again, you can see that it's just slightly broken through that line a little bit more. It actually broke through a little bit at the end of October, and then early November, it peaked a little bit, got pushed a little bit more through. So this chart here compares the CRB composite to the Canadian dollar. As you can see, the two move fairly closely together on a month-to-month basis, not so much on a day-to-day basis, but on a month-to-month basis. They're very similar. To the extent that when you get a long-term KST buy signal on the Canadian dollar, if you look up here at the CRB composite, it's generally a good place to buy the CRB composite, because each time we get one of these buy signals, you get a rally in the CRB. And here again, it's right spot on the low for the CRB. So right now, we've got a tentative little buy signal here on the Canadian dollar, and the Canadian dollar has broken above this downtrend line. So, and it's above its 12-month moving average. So we're getting some tentative signs that the Canadian dollar has reversed and is now in a bull market. So let's just take a closer look at that Canadian dollar, because when the Canadian dollar turns, then commodities have a strong habit of turning. What you can see here is the cop-up curve of the Canadian dollar has been, whereas the slower moving KST has just started to turn. The cop-up curve has been turned for quite some time. And we can see we draw a steeper trend line. That's been violated too. So it seems to me there's pretty high odds that the Canadian dollar is bottom. When the Canadian dollar goes higher, so too, generally speaking, do commodities. It's not a guarantee, but it's certainly a good probability. Now we're looking at another currency, the Australian dollar. And here is the Australian dollar KST bottoming out. What happens to the CRB, which is this series here? It rallies to the upside, generally speaking. Having said that, there's a great exception to the rule where the KST turned up for the Australian dollar. It was a false signal, and the CRB failed within a few months. But if that's the case, you get some idea, because the KST then subsequently turns over and the CRB breaks below its moving average. And that's just not what we're seeing at the present time. So that looks fairly encouraging. Not as encouraging as the Canadian dollar. So I'm going to just quickly flip through here and talk a little bit about the DB Base Metal Fund, the DBB, which moves fairly closely in concert with the CRB Spot Raw Industrials. And if you remember, the CRB Spot Raw Industrials experienced the marginal new low in October, and its long-term KST was still falling. So was the KST for the DB Base Metal Fund still falling, but it looks like it's reached a very important inflection point. I'd say that the trend is still negative, but it looks like it experienced a false break below this red trend line here, which marked the lower area of the head and shoulders top. We've got the shoulder, the head, and I put a question mark in the right shoulder because the price is now the price has now moved back above that right shoulder, that breakdown level. So generally speaking, when I'm looking at this kind of thing, this situation, I'm trying to question whether it's a false breakout. The first sign it's a false breakout comes when the price rallies back above the breakdown level. Then the most important area to surpass is the line joining the head with the right shoulder, provided it's not too steep. If it's very steep, it's an unsustainable trend, and it doesn't have a great deal of authority. But this line here is a very significant one because it's been touched on 3 occasions, maybe a little bit more with the minor rallies here. It's a relatively low angle of descent, and it does join the head with the right shoulder. It also intersects with this red line here, which is the 200-day moving average. And the 200-day moving average in its own right is a very important support resistance level. If you look on the chart here, you'll see lots of dashed arrows here. And that's because the price failed to cross through its 200-day moving average and failed to break below, break above here and break below here. And the same thing all the way through. All these little dashed arrows show you how important the 200-day moving average has been. And the solid arrows tell you when it actually did break. And that usually signaled an important downtrend, or in this case here, an important uptrend that took place. So we're right at that 200-day moving average, we're right at that dashed trend line, and we're right at the resistance of these 2 little rallies here. So at this level here, just under $16, the DB Base Metal Fund is at a very significant level. If it goes through, that will be a very powerful piece of information that base metals have begun a bull market, in my view. So a couple more charts before we open it up for some of Greg's questions. I just want to show you what the bond market players are doing in terms of forecasting commodity prices. So here we have the CRB composite. Underneath is the iBox high yield shares, the HYG, relative to the treasuries, the 7 to 10 year treasuries, the IEF. And we're looking at on a purely price basis here. We're not including dividends or interest. So basically what this is telling you is when the line is rising, it means that people are buying the high yield. They're willing to take the high yield and overlook the safety of the treasury. When it's falling, it means they're buying treasuries over high yield bonds because they want safety and they're willing to forego the high yield. Point is that this ratio moves in tandem with the CRB composite. You can see from these green arrows here. So we've got the CRB composite, which is has just started to break above this red downtrend line here. We've got the fourth break to the downside. We haven't had that confirmed yet with the confidence ratio, but that's something I'm really watching very closely indeed to see if this confidence ratio moves above this 79.79 level. Right now, it's not confirming the breakout in the CRB composite, but we'll have to wait and see what happens. It's something certainly worth watching. So here we now are looking at the commodity markets and the stock market. Here's the commodity market, the DBC, which is the DB Commodity Composite Index. And underneath are two stock market ratios that pit inflation stocks against deflation sensitive stocks. The Goldman Sachs Natural Resource ETF against a defensive consumer staples, spider consumer staples. And here is my inflation ratio against my inflation index against the deflation index, both of which consist of four different sectors or industry groups. One is sensitive to inflation, like mines and energy and so forth, and the other is more defensive, including utilities and consumer staples and so forth. So when both these series move up and down, they move up and down in tandem with the commodity prices. Here again, the stock market, just like the bond market, is saying we're very close to a signal. We haven't broken out yet. It's right at its 200-day moving average in this trend line. It's just below this trend line here, and of course the DB index itself is just slightly above the downtrend line and slightly above its 200-day moving average. So this is all poised, ready to break to the upside. Until it does, we have to assume there's no breakout. When it does, this is going to be very powerful information that we're in a commodity bull market. So here's the DBC itself. Again, right at this trend line and the 200-day moving average. And, I should say the 65-week exponential moving average, because it's a weekly chart. And you can see that the intermediate and short-term KSTs are both in a rising mode. So when you're in a rising mode, that adds strength to the idea that this may result in an upside breakout next week or the week after. If commodities are going to go up, chances are that the dollar is going to be struggling. And that's what seems to be happening here. Here's the special K for the dollar. It's still in this uptrend here, and the dollar index itself is still in this uptrend. But it looks like it may break to the downside because the short-term KST is in a bearish mode. And then finally, we have a look at it more broadly, because the US dollar index includes 57% weighting for the euro. Here's the USDU, the Wisdom Tree Bloomberg dollar bullish fund, which is a more broadly based index. And it's telling you basically the same thing, that the dollar is right at crucial support. So you've got the dollar at support and you've got commodities at resistance. It's going to be an interesting week next week. What do you think, Greg?
I think that is so true. I've been watching the commodities more on a weekly basis. You're using a lot of your long-term KSTs, and on the weekly basis, I've been, COPIC, so COPX is the ETF, which is the copper miners. That chart's been rising for 4 weeks. We're starting to see, really nice pushes. The steel ETF SLX broke out this week. So across the range, I'm seeing some really nice price action on the commodities, and the US dollar rolling over. I don't think you showed it with your special K, but the special K for the US dollar is rolling over as well. So lots of really critical information, I think, is starting to point, leaning I'll call it leaning in on a commodities trade here, especially in the industrial metal space. I did want to ask you one question about, I think it was a few years ago when we were doing one of these monthly presentations, and you had mentioned that, gold leads commodities on a long-term basis. So, a gold move might start a year earlier or 6 months earlier, and then, you'll see the rest of the commodities kind of follow on that lead sometime later on. Uh, do you remember that? And have you thought about that with gold breaking above 1375?
Oh
And
yeah,
now,
I've been following that closely because I've been looking for an entry point into the commodity area. And I put it in last month's intermarket review, a chart that compares the KST, excuse me, the KST of the CRB composite, sorry, the CRB spot roll industrials, and the KST of gold. And generally speaking, you can write a little green arrow from the low end of KST for gold to the low end of KST for the CRB. And the other thing is if you run a ratio of the gold price to the CRB spot roll industrials, when that ratio is rising, it's not only bullish for gold relative to commodities, but it's bullish for gold in its own right. And when it's falling, it's usually bullish for commodities in their own right, as well as relative to gold. So once gold stops outperforming commodities, that's the time to start looking for commodities to turn up. And right now, that ratio is in a long-term uptrend, but it's got its intermediate and short-term momentum is turned down. The KSTs have turned down for that ratio. And that, again, is another bullish point for commodity prices. So everything seems to be fitting here. And I really like that Canadian dollar because that's looking pretty positive. I'm sure on a personal basis, you're glad too.
I am, it's been a 30% discount for a while. So a US traveler heading to Canada would save roughly a third compared to if they did that same trip in 2010 when the Canadian dollar was $1.10 compared to the US dollar, and now it's about 75 or 77 cents. So it's a real, it's been a significant discount for a long period of time. And obviously, if we started to see the Canadian dollar move up, oil tends to follow the dollar, not just Canadian oil, but West Texas crude and the Canadian dollar seem to move pretty close together. So when you see that, I can't help but be excited for the commodity trades.
Well, you see what I've got on the screen now. It's West Texas with a cop-out curve, and the arrows, of course, point out when the cop-out bottoms from below zero. And it's had a pretty consistent record of calling higher oil prices, and it's started to turn now. Now, oil prices still below its 12-month moving average. And if you were to draw a trend line from the 218 high to the 219 high, I guess, that line probably hasn't been beaten yet, but it's pretty darn close to coming out with a bullish signal here.
Well, and I think, just looking at that 2016 low in oil, it turned up. The rest of the stock market turned up in early 2016. And then after the election in November, then the US stock market really started to accelerate. And, oil has been a pretty good economic demand indicator. And with the European charts starting to break out, oil, I'll call it stabilizing. It hasn't really been able to break down below $50 even on intraday charts. It looks to me like oil is forming a base here and wants to turn up. And I've been talking about that a bit in my webinars, how oil is very resilient at $50. It doesn't seem to want to break down through that.
Well, here's a chart of the DB Energy ETF. And you can see how it's just started to nudge through that trend line there last Friday. Needs to get above its 65 big exponential moving average. But here's the intermediate and the short-term KSTs. They're both in a positive mode here. So again, everything's sort of pointing to interesting action next week or the week after.
Yeah, and I noticed that I think I heard Saudi Arabia plans on having their IPO for their Saudi Aramco company. And
That's right.
I think they have the overall company priced at $2 trillion in terms of total asset value. So that will be a very interesting timing on the IPO to come out just as these charts are starting to change direction. Should make for a pretty interesting IPO.
I'm sure they'd like to get the price up a little bit before it happens.
Yeah, I was going to say they might want to wait until the end of the cycle to price this thing, not the beginning of the cycle. But hey, we'll take the ride. It'll be okay.
Yeah.
Martin, what's your theory or your thesis on that e-commerce gold ratio change? Do you think it's the regulation overhang that's starting to hit these e-commerce giants, or do you think it's just, their PEs are still quite extended and perhaps just due for a mild pullback?
Well, I think it's a basic change that's taking place, and the ratio comprises two parts: the e-commerce and gold. And looking at gold, it seems to me gold has just broken out of a huge base and has the potential to go much, much higher. Not tomorrow, but because it's now experiencing a intermediate short-term correction, but over the course of the next few years. And one of the reasons I think that's going to happen is that gold and the stocks often move inversely. And at some point, we're going to see that Shiller price earnings ratio start to turn down from a very, very high level. And that to me makes the market very vulnerable and will add to it's going to add to the allure of gold. So although I don't know how it's all going to evolve, I think that because gold and the stock market tend to move inversely, it's probably a result of that. And it may not, because it's a very long-term trend, it may extend the base for a couple of years, base building where the gold sort of base builds against the e-commerce index. But I think it's something worth watching.
I do too. The sideways moving gold has just been, drifting sideways. I think it's 8 or 10 weeks now. That's quite an interesting sideways move, and it's been, just when everybody's starting to say gold is, going to break down hard now. It's been very resilient, much like oil, and I keep wondering if that's going to hold. The one correlation I've seen on a shorter time frame is that the TLT and gold have moved, I don't want to say lockstep, but they've been very closely tied to each other. So the question would be, if TLT rolls over, would you expect gold to roll over as well? And we've got about a minute left.
Well, actually, I put a chart on the Intermarket Review this month, which has that exact ratio. And it's right at the point of breakout in favor of gold with the short, as you might expect, the short term and the intermediate KSTs both pointing north.
Yeah. Interesting. I think that's going to be an interesting thing to watch. And for everybody listening today, Martin's Intermarket Review is 35 years and counting. It's a fabulous run through of, about, I'm going to say 50 or 60 charts that are, data that you won't find anywhere else. So Martin, I really do appreciate you taking the time to bring these charts to us. Thank you very much. We have a busy month coming up. I'm actually going to be in Martin's hometown at the end of the month, and we're going to try and get together. So perhaps next month we'll do a live broadcast from sitting side by side and review where we're at the end of November. So we look forward to that.
From Pring Research World Headquarters, Greg.
Yes, that's right. Pring Research World Headquarters. Thanks, everybody, for joining us. Have a wonderful week and month, and we'll talk to you soon. Thanks, everybody. Bye-bye.